Every major economy wants to reduce dollar dependence. China has been trying for 15 years. Russia has been trying since 2014. Europe has been trying since the euro was created. And yet, in 2025, the dollar still dominates. Not because it's strong, but because the alternatives can't function. In the last 2 decades, the dollar's share of global reserves fell from 70% to 57%. But no single currency gained ground. Instead, dozens of smaller currencies absorbed that decline. This is the dollar trap. And understanding why no one can escape reveals how monetary power actually works. In this video, we'll examine why even the world's largest economies remain trapped, the 3 alternatives they've tried, and why each one fails, and the 3 scenarios for what happens next. This is financial mechanics. To understand this trap, we need to go back to 1971. August 15th, President Nixon announces the United States will no longer exchange dollars for gold. The gold standard, dead. Immediate question: why would anyone accept dollars if they're not backed by gold? The answer came in 1973. Henry Kissinger negotiates a deal with Saudi Arabia. All oil will be priced in dollars, not gold, not yen, not any other currency, only dollars. This created artificial demand. Every country that needs oil must first buy dollars. Japan wants oil? Buy dollars. Germany builds its economy? Dollars first. China industrializes? Dollars required. The dollar wasn't backed by gold anymore. It was backed by energy, by necessity. But oil was just the beginning. The system created 3 structural dependencies that locked countries into dollar usage. Dependency 1. Trade invoicing. The majority of global trade is invoiced in dollars. Not just oil, everything: metals, grain, machinery, electronics. To trade globally, you need dollars. Even when China and Brazil trade directly, they often use dollars as the intermediary currency. It's easier. The infrastructure exists. The liquidity is there. Dependency 2. Reserves. Central banks hold dollars in reserve. Why? Because they need to intervene in currency markets. And to intervene, they need dollars. Here's the trap. Countries hold dollars to protect against dollar volatility. But holding dollars makes them more vulnerable to dollar policy. It's a circular dependency. Dependency 3. Debt denomination. Countries borrow in dollars. Trillions of debt denominated in dollars. Even if they want to exit the system, they must repay in dollars. Turkey owes dollars. Argentina owes dollars. Indonesia owes dollars. Exit the system? You still owe. The debt doesn't disappear. But the system isn't just monetary. It's infrastructural. SWIFT, the messaging system that routes payments between banks, 50 million messages per day, 11,000 institutions connected, 80% of cross-border payments, built over 50 years, cooperative ownership, proven security, 99.999% uptime. Replacing SWIFT means rebuilding the entire global payment infrastructure. Banks estimate $10 to $20 million per institution just for the software integration. Training, compliance, testing, and that's just the technical cost. The real cost is network effects. Every bank is connected to every other bank. If you leave, you lose access to 11,000 institutions. Your customers can't send or receive international payments easily. So here we are. The dollar weakening, confidence declining, but the infrastructure remains. Now, countries are trying to escape. Let's examine why they're failing. China is the world's 2nd largest economy. If anyone could create a credible alternative, it should be China. Since 2015, China has been internationalizing the yuan. Belt and Road projects financed in yuan. Shanghai oil futures priced in yuan. CIPS, their alternative to SWIFT. Real progress. In 2024, about 4% of global trade used yuan, up from 2% a decade earlier. But there's a structural limit. The yuan isn't freely convertible. China maintains strict capital controls. You can't buy and sell yuan as freely as dollars. Why? Because full liberalization means losing control. Massive capital flows could destabilize the Chinese economy. In 1997, Asian countries learned what happens when hot money floods in and out. China remembers. Here's the fundamental contradiction. To be a global reserve currency, you need free capital movement. But free capital movement creates vulnerability. China can't solve this dilemma. They won't give up control for internationalization. So the yuan grows, slowly, regionally. But it can't replace the dollar, not while Beijing maintains capital controls. The euro seemed like the perfect solution. 20 countries, 340 million people, 20% of global GDP. And yet, 25 years after its creation, the euro represents only 20% of global reserves. The dollar, 57%. Why? Problem 1. Political fragmentation. 19 countries. 19 budgets. 19 fiscal policies. One currency. But no fiscal union. When Greece collapsed in 2010, there was no unified European treasury to respond. Just endless negotiations between 19 governments. Confidence shattered. The euro has monetary union without fiscal union. That's like having a shared bank account with 18 roommates, but no agreement on who pays for groceries. Problem 2, no unified safe asset. The dollar has U.S. treasuries. $27 trillion. Liquid. Uniform. Safe. The euro has German bonds, French bonds, Italian bonds, Greek bonds, each with different risk profiles. No unified European bond market. Reserve managers want to hold euros. But where do they put that money? German bonds are safe but scarce. Italian bonds are plentiful but risky. This fragmentation prevents the euro from functioning as a true global reserve currency. The euro works regionally, but globally, it can't compete. Not without fiscal union. And fiscal union is politically impossible. 2023. The BRICS nations announce plans for a common currency. A new payment system. An architecture to challenge the dollar. Media excitement. The end of dollar dominance. Reality, 2025. No BRICS currency exists. No unified payment system operational. Why? Problem 1. Diverging interests. Russia wants to evade sanctions. China wants to promote the yuan. India refuses yuan dependence. Brazil just wants to trade. South Africa and Indonesia backed away after Trump's tariff threats. 5 countries, 5 agendas. No shared vision. Jim O'Neill, the economist who coined the term BRIC, said it bluntly. The idea of BRICS challenging the dollar is fantasy as long as China and India remain divided. Problem 2. No institutional trust. A reserve currency requires trust. Trust in stability. Trust in institutions. Trust in rule of law. The dollar has that trust, even if weakened. The euro has it, partially. The BRICS nations? No. What we see instead is incremental progress. Russia and China settle 99% of bilateral trade in local currencies. Brazil and China signed agreements. India and Russia trade energy in rupees. But these are bilateral arrangements, not a global system, not a dollar replacement. The BRICS nations won't replace the dollar. They'll fragment its hegemony. Slowly. That's a crucial distinction. What about gold? Return to the gold standard? Simple arithmetic. All the gold ever mined is worth about $15 trillion at current prices. Global money supply? 87 trillion. Global trade? 25 trillion per year. There isn't enough gold, even at vastly higher prices. And even if there were, how do you pay digitally with physical gold? How do you ship tons of gold for international payments? How do you adjust money supply flexibly during a crisis? The 1920s and 30s showed what happens with a rigid gold standard. Deflation, depression, mass unemployment. Britain, Japan, and the US all abandoned gold between 1931 and 33 for good reason. Gold works as a store of value. Central banks buy it as a hedge. It's 20% of global reserves now, second only to the dollar. But as a monetary system for a $100 trillion digital economy? Impossible. So here we are, dollar weakening. But no alternative works. What happens next? Scenario 1. The dollar persists. Not because it's strong, but by inertia, by lack of alternatives. The network effects are massive. SWIFT handles 50 million messages daily. 11,000 institutions connected. Replacing that infrastructure would take decades. U.S. Treasuries provide $27 trillion of liquid, safe assets. No other country offers comparable depth. As long as no credible alternative exists, the dollar remains dominant, even weakened, even contested. This is the paradox of the system. Everyone wants to exit, but no one can exit alone. The infrastructure is too entrenched. The switching costs too high. The alternatives too immature. Probability for the next 5 to 10 years, 70%. Scenario 2. Slow, multipolar transition. The dollar doesn't collapse. It declines gradually. Look at reserve shares over time. 2000, $70%, Euro 20%, others 10%. 2025, $57%, Euro 20%, Yuan 2%, others 21%. By 2040, maybe dollar 45%, Euro 20%, Yuan 15%, others 20%. Not replacement, fragmentation. Regional trade shifts to local currencies. Asia uses more yuan. Europe uses more euro. Latin America diversifies. The global system becomes less integrated. More friction. Higher costs. But also more regional resilience. This is what happened to the British pound. From 1914 to 1971, 57 years of gradual decline. Not collapse. Managed transition. The dollar could follow the same pattern. Decades of slow erosion. Probability for 10 to 30 years. 60%. Scenario 3. A new anchor emerges. But what? A basket of currencies? Special drawing rights? Enhanced? A global digital currency, not tied to any nation? A commodity-backed system? Something we haven't imagined yet? In the 14th century, Ibn Khaldun theorized that hegemonic cycles follow patterns. Rome, Byzantium, the Caliphates, the Mongols, European empires, the United States. Each transition took 50 to 150 years. Each new system looked different from what came before. The gold standard didn't resemble the silver standard. The Bretton Woods system didn't resemble the gold standard. The post-Nixon dollar system didn't resemble Bretton Woods. So the post-dollar system probably won't resemble the dollar system. We're at the beginning of this transition, not the end. The outcome is fundamentally uncertain. Probability for 30 to 50 years? Impossible to quantify. In the 1400s, Ibn Khaldun observed that hegemons don't collapse overnight. They decline slowly, over generations. Power persists even when weakened, through infrastructure, through habit, through the absence of alternatives, until conditions shift enough for a new system to emerge. We're living through that transition, the end of the 1971 system, the beginning of something else. The dollar trap isn't eternal, but dismantling it will take time, perhaps decades. And what comes after? We'll discover that in real time. The next chapter of this transition is already being written. If you want to follow how it unfolds, subscribe to Financial Mechanics. We'll continue documenting this historic shift, one video at a time.